November 12, 2025. Internal Microsoft financial documents leaked. Ed Zitron, a technology blogger with access to internal Microsoft financial documents, publishes analysis revealing that OpenAI spent $8.7 billion on inference costs through the first 3 quarters of 2025. Not for training new AI models. Not for research and development. Pure inference, the computational cost of responding to user queries on ChatGPT. That's $32 million every single day, just to keep ChatGPT running. The number represents more than double what OpenAI spent on inference during all of 2024. Yet when you ask ChatGPT to write a simple email, compose a poem, or answer a basic question, the interface suggests these interactions cost nothing beyond a monthly subscription fee. The financial forensics reveal something far different. Every ChatGPT conversation is subsidized by venture capital at a loss rate that makes most startups look profitable by comparison. This isn't a story about AI capabilities or technological progress. This is the collision between exponential user demand and linear computing economics, playing out in real time across financial statements that suggest the most valuable AI company in history may be burning cash faster than any startup ever created. The revelation starts with understanding what inference actually costs. When you submit a prompt to ChatGPT, the system doesn't simply retrieve pre-written responses. It performs billions of mathematical calculations across thousands of GPU processors to generate each word in sequence. Every sentence requires computational work equivalent to complex scientific simulations, executed in milliseconds to maintain the illusion of natural conversation. OpenAI operates approximately 290,000 servers containing NVIDIA A100 chips dedicated specifically to ChatGPT inference, according to industry analysis of Microsoft's infrastructure allocation. These servers run at near full capacity, consuming electricity, requiring cooling, and demanding constant maintenance. The hardware alone represents billions in capital expenditure, but the operational costs dwarf the equipment investment. Microsoft charges OpenAI heavily discounted rates for Azure cloud services through their strategic partnership, yet the discounted rates still resulted in $8.7 billion in inference costs for 9 months of 2025. This suggests the actual computational expense of running ChatGPT, without Microsoft's subsidized pricing, would be exponentially higher for any competitor attempting to match OpenAI scale. The mathematical relationship between usage and cost creates a fundamental business model problem. Unlike traditional software applications that serve unlimited users with minimal marginal cost increases, AI inference scales linearly with usage. Every additional user query requires proportional computational resources. Doubling ChatGPT's user base doubles the inference costs, without necessarily doubling the revenue. OpenAI's revenue structure compounds this economic challenge. The company generates approximately $3 billion annually from ChatGPT subscriptions and $1 billion from API access, according to leaked financial documents analyzed through Microsoft's revenue sharing payments. The subscription model charges users $20 monthly for unlimited access, while the free tier provides substantial access without any user payment. Heavy users of the unlimited subscription create disproportionate inference costs. A user generating thousands of queries monthly consumes exponentially more computational resources than casual users, but both pay the same subscription fee. The economic model incentivizes exactly the usage behavior that drives costs higher while revenue remains fixed. The scope of OpenAI's financial losses becomes clear when comparing inference costs to total revenue. Inference costs alone, $8.7 billion through 3 quarters of 2025, exceed OpenAI's projected annual revenue by substantial margins. This excludes training costs for developing new models, research and development expenses, employee salaries exceeding $700 million annually, and standard business operational costs. The information reports that operating OpenAI cost $9 billion during 2024, generating $4 billion in revenue, resulting in a $5 billion loss. The 2025 financial trajectory suggests accelerating losses as inference costs outpace revenue growth. OpenAI spent $2.25 to generate each dollar of revenue in 2024. If this ratio continues, projected 2025 revenue of $11.6 billion would require operational spending exceeding $26 billion, creating losses of $14.4 billion. These numbers represent more than unsustainable unit economics. They suggest that ChatGPT's current pricing model cannot support the computational costs required to operate the service at scale. Every user interaction represents a negative contribution margin that worsens as usage increases. The technological constraints driving these costs are fundamental, not temporary. AI inference requires specialized hardware, NVIDIA H100A100 GPUs, that costs hundreds of thousands per unit. The chips consume massive amounts of electricity while generating heat that requires expensive cooling systems. Alternative hardware doesn't exist at the performance levels required for competitive AI responses. Training new AI models adds another layer of computational expense that compounds the inference problem. OpenAI spent approximately $3 billion on training costs during 2024, funded primarily through Microsoft credits rather than cash payments. However, inference costs are paid in cash, creating immediate pressure on OpenAI's capital reserves. The dependency on Microsoft's infrastructure creates both operational advantages and strategic vulnerabilities. Microsoft provides discounted Azure services and covers substantial training costs through cloud credits, effectively subsidizing OpenAI's operations. Without these subsidies, OpenAI's losses would be even more extreme. However, this dependency also means OpenAI cannot easily diversify its infrastructure or negotiate better terms with alternative providers. Recent expansion into additional cloud providers, including agreements with CoreWeave, Oracle, AWS, and Google Cloud, suggests OpenAI recognizes the risks of Microsoft dependency. However, these agreements require additional capital commitments. The CoreWeave deal alone represents $12.9 billion over 5 years, with payments beginning in October 2025. The competitive landscape reveals why these costs cannot be easily reduced. Google, Anthropic, Meta, and other AI companies face identical computational requirements for running large language models. The inference costs are determined by the fundamental architecture of transformer-based AI systems, not by operational inefficiencies specific to OpenAI. Competitors attempting to match ChatGPT's capabilities must accept similar cost structures. Price increases represent the most obvious solution to unsustainable unit economics, but market dynamics prevent straightforward pricing adjustments. ChatGPT faces competition from free AI services provided by Google, Microsoft, Meta, and Anthropic. Raising subscription prices above competitive levels would drive users to alternative services with similar capabilities. Moreover, the value proposition of AI services remains difficult to quantify for most users. While ChatGPT provides useful functionality, the utility doesn't clearly justify subscription costs that would cover the actual computational expenses. Business customers show more price tolerance, but consumer adoption drives the majority of usage volume. The revenue sharing arrangement with Microsoft adds complexity to OpenAI's financial structure. Microsoft receives 20% of OpenAI's revenue through their strategic partnership, while simultaneously providing Azure services and sharing revenue from Bing and Azure OpenAI service. The bidirectional financial relationships make it difficult to calculate OpenAI's net profitability, even with complete financial transparency. Leaked documents suggest OpenAI paid Microsoft $493.8 million in revenue sharing during 2024, increasing to $865.8 million through the first 3 quarters of 2025. These payments represent 20% of OpenAI's gross revenue, but Microsoft also returns approximately 20% of revenue generated from Bing and Azure OpenAI services. The net financial flows between the companies are substantially more complex than the headline numbers suggest. The broader AI industry faces identical challenges, but most companies operate at smaller scales that make the problems less visible. Anthropic, Cohere, and other AI startups spend substantial portions of their venture funding on computational costs for model training and inference. The difference is scale. OpenAI's usage volumes make the unsustainable economics more apparent and more urgent. Venture capital markets have funded AI startups based on growth metrics and technological capabilities rather than unit economics or paths to profitability. OpenAI's $6.6 billion funding round in October 2024 valued the company at $157 billion based on revenue growth and market position, not financial sustainability. The valuation implies investors expect either dramatic cost reductions or substantial revenue increases to justify the investment. Recent developments suggest both scenarios face significant challenges. Computational costs continue increasing as users generate more complex queries and demand higher quality responses. Training more advanced AI models requires exponentially more computational resources, increasing the baseline costs for competitive performance. Meanwhile, revenue growth faces constraints from competitive pressure and limited willingness to pay premium prices for AI services. The technological pathway to cost reduction involves improving computational efficiency of AI models without sacrificing response quality. Alternative approaches include developing specialized hardware optimized for AI inference, implementing more efficient model architectures that require less computation per response, and creating tiered service offerings that match computational costs to user value. Each approach requires substantial additional investment and technical risk. The economic sustainability crisis extends beyond OpenAI to the entire generative AI industry. If the largest, most successful AI company cannot operate profitably at scale, smaller competitors face even more severe financial constraints. The industry's dependence on venture capital subsidies becomes problematic when funding markets reassess the viability of businesses that lose money on every user interaction. Market dynamics suggest two possible outcomes: dramatic restructuring of AI service pricing to reflect actual computational costs, or consolidation around a small number of companies capable of sustaining massive losses through cross-subsidization from profitable business units. Google and Microsoft can absorb AI losses through advertising and cloud service revenues. Standalone AI companies cannot. The consumer expectations established during the venture capital subsidy period create additional challenges for transitioning to sustainable pricing. Users accustomed to unlimited AI access $4.20 monthly may not accept pricing models that reflect actual computational costs. Educational and research users who depend on free access would be excluded from services requiring economically rational pricing. Sam Altman's recent statements about OpenAI expecting revenue to exceed $20 billion by the end of 2025 and potentially reach $100 billion by 2027 assume continued exponential revenue growth without corresponding increases in unit costs. The financial evidence suggests these projections require either breakthrough efficiency improvements or willingness to operate at massive losses indefinitely. The implications extend beyond individual company financial health to broader technology industry investment patterns. AI infrastructure buildouts, semiconductor demand, cloud computing expansion, and data center construction have been driven by assumptions about sustainable AI service economics. If the unit economics prove fundamentally unviable, the entire infrastructure investment thesis requires reassessment. The revelation becomes particularly significant when considering the $100 billion investment announced between NVIDIA and OpenAI for AI supercomputing facilities. These investments assume continued growth in AI service demand at pricing levels that support the infrastructure costs. If pricing must increase dramatically to achieve profitability, demand patterns could change substantially. The financial forensics reveal a pattern consistent with previous technology bubbles: rapid scaling of services with unsustainable unit economics, funded by venture capital expecting future profitability through scale economies or pricing power that may not materialize. The difference is the computational intensity of AI services creates physical constraints that limit the efficiency improvements possible through scale. OpenAI's situation represents the most extreme example of AI service economics, but the underlying dynamics affect every company attempting to commercialize large language models. The computational requirements are determined by the mathematical architecture of AI systems, not by business strategy choices. Alternative approaches must either accept similar cost structures or sacrifice competitive performance. The resolution requires acknowledging that AI services may be fundamentally different from software applications that achieve positive unit economics through scale. AI inference costs scale linearly with usage, creating ongoing expense requirements that cannot be eliminated through operational efficiency. Sustainable AI business models must account for these computational costs from the beginning, rather than assuming they can be optimized away over time. The investor perspective reveals why these unsustainable economics received funding despite obvious mathematical problems. Venture capital markets operated under assumptions that AI companies would achieve network effects, pricing power, or efficiency improvements that would eventually justify massive upfront losses. However, AI services demonstrate few network effects compared to social media platforms. ChatGPT's value doesn't increase as more users join the platform. The competitive dynamics prevent the pricing power that investors expected. Multiple companies offer comparable AI capabilities, preventing any single provider from charging prices that reflect actual computational costs. Google's Bard, Microsoft's Copilot, Anthropic's Claude provide sufficient alternatives that users can switch providers if prices increase substantially. Corporate customers represent the most promising segment for sustainable pricing, but enterprise adoption patterns limit revenue potential. Businesses willing to pay premium prices typically require customization, security, and service-level agreements that increase operational costs beyond standard inference expenses. The international competitive dimension adds urgency to achieving sustainable economics. Chinese AI companies operate under different cost structures and government support mechanisms. DeepSeek's reported efficiency improvements demonstrate that alternative approaches to AI service economics may be possible, but implementation requires fundamental changes to existing systems. The infrastructure implications extend to electrical grid capacity, data center construction, and semiconductor manufacturing. The AI inference costs driving OpenAI's financial losses represent demand for computational resources that require massive physical infrastructure investments. If AI service economics cannot support these infrastructure costs, the entire technology stack faces oversupply conditions. The autopsy is complete. ChatGPT's hidden compute bill reveals systematic cost structures that challenge the fundamental business model assumptions underlying the AI industry. Every user query represents a loss-generating transaction subsidized by venture capital. The scale of these losses, $8.7 billion in 9 months for inference alone, exceeds the operating costs of most Fortune 500 companies. The beneficiaries are users receiving subsidized AI services and cloud infrastructure providers collecting computational revenue. The cost is borne by investors funding operations that lose money on every user interaction, with no clear pathway to profitability at current service pricing levels.